Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. Main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, it seems the Israeli ceasefire is putting a bid under the market today. But isn't this what Rob's been saying all along? And I know Trump shared some comments or emotions, rather, on the violations of the ceasefire as well that have just transpired not too long ago. So interested to hear Rob's thoughts on that. And of course, very excited to interact with you all. So, Rob, you out there? Let's get right into it.
I am Zach. How are you? Happy Tuesday afternoon, everyone. Welcome to Trade Finder Live. I will do my best to get through this entire presentation without moving into a sneezing fit, but no promises because it's been a rough morning. It is hot up here in the mountains this week, and it's been hot in the markets today as well. Yep, the notification of Israel-Iran ceasefire definitely sprouted the futures to the upside. You can see that we gapped up in today's trade, which I hate. I wish we wouldn't have gapped up. But it is following, as you mentioned, Zach, the zigzag forecast. You can see the three C's right here. All three zigzags, the primary one, the two complex ones, all telling that we should go test those February highs. We're getting there. We're not too far away. But what about the gap? Do we have to fill that first? Is this a breakaway gap? Are we going to take off and run? We'll have to see in the next couple of trading days how all that plays out as we move forward in the markets. But for now, that's where we are. And I think the market, even though the quote ceasefire did seem to put a bid under the market, I could argue that it's more Iran's ineptness. Um, is that a word? They've been pretty inept in their attacks, trying to attack Israel after Israel's initial strike, where what only a few of the many missiles that they launched actually landed, and none of them hit any targets, and they were able to take most of them out. And then even when they tried to retaliate yesterday on the U.S. troops in Qatar, most of those missiles were intercepted as well. So I don't think they feel like Iran's retaliation is too much of a threat. At least that's where we are now in the markets. Things always subject to change. We are still on heightened alert for any sort of domestic attacks. We don't know who might be here, but for now, the markets are shaking all that off. And historically, like it or not, but historically, war times have been positive for equities markets. It may seem counterintuitive, but that's where things are. So we'll move forward here. We had Chairman Powell testifying in front of Congress. I talked about this before. It's the old Humphrey Hawkins testimony, which was the two congressmen that created the legislation. It did expire years ago, but the Federal Reserve still comes and testifies in front of Congress twice each year, and they ask really ridiculous questions. But everybody looks for their 5 minutes of fame. Literally, they get 5 minutes to ask questions, and you just have to shake your head at some of the questions. We all know that President Trump has been trying to put pressure on Chairman Powell to cut rates, and now it's a little bit tricky within the Federal Reserve because there's three Fed governors that are now coming out saying they would be in favor of a rate cut in July. I don't think Chairman Powell wants to do that at all. So I don't know that that's a majority of the FOMC, the voting members of the Federal Open Market Committee, but at least it shows that we are leaning towards some sort of a rate cut. Chairman Powell actually testified that, believe it or not, the model that they look at says do nothing, and one piece of their model says they should hike rates. Um, but that's because they're programming in some inflation from the tariffs, which so far, really, there haven't been a whole lot of tariff activity. And we had a couple people come out and say, yeah, but there's a lot of trade deals that are almost finalized that haven't been announced yet. The pause ends July 9th, which is when we could go back into some heavier tariffs. That might shake the markets a little bit. Who knows where we'll be when we get to July 9th. But when we go up and test these February highs, that's where everything could change. We could get a corrective move at that point in time. Are we going to bust above those February highs? Are we just destined to test them and fall back a little bit? As you know from zigzag patterns, what normally happens is after the C wave is completed, you have a move that retraces the C wave. Are we just going to retrace the first one? Are we going to retrace the second one? I don't think we go all the way back down here to retrace the initial one. That brings us all the way back in the neighborhood of the tariff tantrum lows. So I don't think that happens. But that's the news. That's what's going on. And so far, moving to the upside. With this, I like to look at the confirming indicators and notice the CCI, where we have come back down to the 0 point and bounced up. And that's a positive on the very short term. The ADX slash DMI, as you know, is a little bit more of a lagging indicator. It takes a while. We do have a bit of a separation here, early separation between the two directional indicators. And the ADX maybe is trying to turn up, but you can see how it dwindled down through this consolidation period here, following a little bit of a weak breakout and then a test of the breakout. So that's what's occurring. So let me take this other stuff off and go back to the actual chart. We had such a complex C wave here, zigzag pattern to the upside. Not only do we have two different zigzags within the primary one, but we also had a triangle in the last zigzag pattern. So even that was complex. So it is a complex set of what Elliott Wave calls corrective patterns, flat zigzags or triangles. But remember that a zigzag is a directional pattern. People get confused by that because it's labeled as a corrective pattern. Why is it labeled as a corrective pattern? Because flat zigzags or triangles are what normally occurs when a wave 5 ends. So we do have this big zigzag here that's going on, following a perfect zigzag to the downside at the end of that wave 5. So we're in zigzag mania right now. We completed our zigzag mastery class last week, the master class on zigzags, where for 4 weeks we talked about the intricacies of zigzags. And I just feel that everyone should incorporate this into their trading toolbox, regarding of what indicators you like or you look at. But these zigzags work. I didn't get them on my own. I simply read what Elliott wrote, and he loved the zigzag pattern. It was his favorite of all patterns, even more than the 5-wave pattern, which is what Elliott Wave is famous for. So I figured maybe I should take a look at those, and they've worked out extremely well. Again, the only concern I have on the move today is the fact that it was a gap up. Maybe we have to retrace that first, or maybe we have a breakaway gap. We go up and hit these targets and then come back down. We'll have to see. But the one thing we did do is break out of this triangle, come back and test the point of the triangle, and then have moved back up. That's what's supposed to happen out of triangles. As we move on, let's go to the bond market. Pardon me real quick, because the bond market and the dollar have been quite cooperative. You can see that we are in this upward trend channel, going back to old school technical analysis that I've been talking about. Went through this in the U.S. market update over the weekend. Hopefully everybody's had a chance to go through that. I feel like it was a pretty good one. We showed some really interesting macro charts from the guys that are the data scientists at the Hub organization, HUBB.com. I assume everyone watching this has the software. If you don't, you can go to HUBB.com and get a copy of it for free. You get free Elliott Wave. You have the opportunity to subscribe to the AI signals if you want, which have been absolutely amazing. I think that's a really good thing to do if you haven't. But regardless of whether you choose to do that or not, you can actually get the software and the Elliott Wave for free. But going back to the TLT, remember that's prices on the 20-year, prices and yields move inversely. I know a lot of you hear this week after week after week, but we have new viewers every week. So I want to catch everybody up to date. And so what should happen as I extend this channel here on TLT is we should continue up in prices and therefore down in yields. And the one thing that I don't think enough people are taking a look at, and if you go watch that US market update showing those macro charts from the data scientists, they showed how the Federal Reserve is in fact injecting liquidity into the markets. And I don't know how, and I'm not a Fed fan. I'm not a fan of the Federal Reserve system. I'm not a fan of an independent group controlling money for the United States. I've always said that, but that's the system that we have. And I got to give Chairman Powell some credit, and I'm usually very critical of keeping his mouth shut and not retaliating on the constant barrage of comments that he's getting. Feels like he would want to come out and say that, hey, we may not be cutting rates, but we're putting liquidity into the markets in a different way. They have a number of different ways they can inject liquidity, and those macro charts show that and showed an amazing correlation of how the markets move based on liquidity. There's a little bit of lag time in the market reaction to Fed injection or withdrawal of liquidity. Both of those are shown in the macro charts. And that's what they're doing behind the scenes, which is part of the reason why they are so intent, or at least Chairman Powell. Now he's starting to get, some squabbling amongst his own Fed governors on not cutting rates yet. I don't know. Maybe there's some governors that are up for reappointment. I don't know. But there is a little bit of dissension in the ranks where everybody was intent on waiting. And now there's a few that are breaking from the pack and saying that they'd be in favor of a rate cut in July. I don't think it's a majority. I don't think we're going to get a rate cut in July. It's at 17% on the Fed fund futures, which basically means it's probably not going to happen. We're still above 70% for September, and the next one has been wobbling between October and December. But the next one where we get a 70% or higher percentage chances for December. So we've been looking for rate cuts in September and December. And I feel like that's probably where we are, especially since the Fed is doing some things behind the scenes to help out the markets without coming out and talking about it. Is basically where we are. So the TLT should go back and retrace this C wave that occurred here, continue up in this channel until we at least reach this B. So we retrace the C wave, then we'll see what happens in rates. But for now, it looks like prices continue to go up on the 20-year and then down in yields. So if I go to the TNX, that's the opposite. So that's the 10-year, but it does show rates. It doesn't show prices. So the TNX shows rates on the 10-year where the TLT shows prices on the 20-year. And you can see this downward breakout from this triangle. Does that continue? Right now, the breakout is just taking us back to the point of this. And granted, it wasn't the greatest formulation of a triangle. There was consolidation clearly from the lower highs and higher lows, but there was too much open space here for me to really put a whole lot of weight in that triangle, which is, I think, why we broke out and didn't fulfill what normally happens on a triangle, where you move to the price level difference in the mouth of the triangle on the breakout. We had a breakout. We've come back and look where we are. We are exactly testing the point of the triangle breakout, exactly what we talk about with triangles in the volatility portfolio at ewotrader.com. And what happens now? Do rates turn and go back up? Do we continue down? This is not a false breakout. This was a breakout and a test of the point. So basically that means that this is a completion of this big triangle. But now we have to see what happens with this new triangle. And I commented on that yesterday during our EWO Trader Live session for alert subscribers at ewotrader.com that um, it's been interesting over the last year or two, especially for someone like myself that has been following triangles for a couple decades, really, to have a triangle break out into another triangle. We've seen that several times over the last year or two, and that almost never happened prior to that. You would have a breakout, and then you would have some sort of a move where you would eventually come back and test the point of the breakout, but rarely did you go back to back triangles. And we've had scenarios that I've shown in the past where we had three of them in a row. So we had a triangle, a breakout, formulate another triangle, and a breakout that formulated another one. I think it just goes to show where we are in the markets with lots of uncertainty, creating these consolidating triangle patterns here. But in general, the pessimism is so high that in itself is enough ammunition, in my opinion, to take us back up to those February highs. As you probably know, when everybody views the market one way, it tends to go the other way. And so that's the path of least resistance is when everybody views things, not everybody, I'm using that in a sarcastic way, but when the majority of traders view things one way, the market normally goes the other way, again, because it's the path of the least resistance. And just the amount of pessimism right now is probably what's going to move up. In fact, when I showed those macro charts that showed that basically the economy is still expanding, a completely different view of what you hear with all the negativity that exists out there. I thought there might be a whole bunch of comments from people saying, "What? The economy isn't expanding. You're crazy. You're wrong." I expected all those kind of comments, and yet the majority of the comments in the U.S. market update were more along the lines of, thank you for the calming influence. This is helping me in this period of uncertainty, which kind of shows how concerned people are right now. But the data never got that bad in the economy, although showing on a weakening economy, but it never got as bad as what people, including myself, thought might occur. So let's move into the crypto space, which is getting a bit of a bid back in today. You can see this move higher here. Again, I talked about this yesterday in the Evo Trader Live session with this break to the downside on BITB, which is an ETF that you can use to trade Bitcoin rather than buying fractions of coins, etc. I think there's better leverage here in these ETFs. A lot of people in the US market update like the IBIT. I prefer the BITB. They're very similar, both very liquid with options. And did we just come down and test the 50-day moving average and then we're going to go back up? And at least for today, that appears to be what's going on. We'll have to wait and see how that plays out over the next couple of days. And same thing with Ethereum, which is interesting and good for those of you that are Ethereum fans, because this was danger zone, danger, danger, Will Robinson right here, as we broke below the 50-day moving average. And with this vertical move from 12 and a half up to 17 and a half on the ETHW with follow through today, we were in danger of coming down to 12 and a half. Well, we didn't get that follow through to the downside, which is why I talk about that rule all the time. We were oversold from the 10-day moving average and we didn't get a follow through. So here we are back up to the 10-day moving average. Can that hold? Can we get a follow through day here and get back above 17 and a half on ETHW? That's something we'll be watching as well. Moving to energy, natural gas coming back down. It seems rather ugly over the last few days, but are we just testing the breakout of this triangle, which is much better, much more well formed here on the triangle on UNG? We had a breakout and we're right at the point of the breakout. So even though it's felt kind of ugly in the natural gas market the past few days, that may be all this is, and we may turn and move back to the upside. We actually have an alert on this in Top Shot within evotrader.com, which is a new product where I send out the best AI trade over the three AI portfolios each and every week. And that's been quite popular. Somebody in the US market update called it Top Gun. It's actually Top Shot, but something new that we've been offering at evotrader.com. So, pretty cool product with a low price point. And having this move here, we're likely going to take off the put side here as we're testing this. All we're going to do is wait to see if we get a reversal. That would be the ideal opportunity to take off one side of the strangle, which is the alert that we have on UNG because of this triangle. And then if it turns and runs back to the upside, then we have an opportunity to do very well. But we'll see. If it breaks lower, then that means this was a false breakout. And then we have an opportunity to do the opposite, take the call off while we run down towards this potential, which still exists, of a wave 5 low on UNG. So you don't jump the gun. Just because we're testing this point doesn't mean that you exit yet. We would need to break this point and show a follow through that we are heading down here. So then we take the call side off and let the put side run. So you can see the strangles give you adjustment opportunities where you can take one side off. The biggest problem that people have when they have these strangles on is they take one side off too soon. That's the greed aspect. The beauty of a strangle is that you're not picking direction. You're letting the market pick the direction. And then if it breaks nicely, you don't have to do anything because one side is making money faster than the other side is losing money, the way we set up the strangles at evotrader.com. And you can still generate a gain by keeping both sides on, or you can maximize your gain by taking one side off. But because of that greed factor, because people are wanting to take the one side off sooner rather than later, they may jump the gun a little bit on doing that. You have to exercise patience and wait for the right time and signals to do that. And we've done a pretty good job of that. We just did that on another alert that we had. So that's what we're looking at there, looking at USO. And as you can imagine, even though Iran has threatened numerous times in the past to close off the Straits of Hormuz, I believe is how you pronounce that. I'm always unsure of exactly how to pronounce that, where a good portion of oil is transported. If those straits were ever blocked off, a blockade, if you will, that would send oil prices higher simply because it would completely slow down the amount of supply that could be put on the markets. But they said they were going to do it before, and they haven't. And so far, they haven't. This time, they're still hinting of that. I don't know what other ammunitions they may have, but so far they've been ineffective on their retaliatory strikes. But with that, oil's come back down. The fact that things seem to have calmed in the ceasefire, you can see we had this big move down, but once again, we went too vertical, too fast. We got too far from the 10-day moving average. We took care of that yesterday, and now perhaps we're down, moving back to the point of this triangle. At least for now, we're testing the 50-day moving average. That's where we are today, and that's all technical analysts can do is analyze the data they have on any given day, knowing that things are subject to change. And you better be quick to adjust with the markets, or you're not going to be around trading for very long. You're not going to be successful. So we watch now to see, does the 50-day moving average hold on oil and we bounce back up, or are we going to break that 50-day moving average and come all the way down to the point of the triangle, fulfilling that where you test the point following a breakout? So we'll have to wait and see on those. The dollar still hanging in there pretty well. We had a little bit of a helpful bid here, I think, with this war stuff, because we still want to view the dollar as the currency of last resort. I would have liked to have seen a little more of a bounce in the dollar here, a little stronger move back off of these wave 3 lows. We did break those, but no follow through, just the one day, enough to label the wave 5, but we didn't have follow through to the potential move down here towards this tap box wave 5 low. That could still happen, especially with where the dollar is acting. But I'm going to still keep a close eye. Same story here on the dollar of this 97.5 level. If we break that, I do think initially that would be viewed as a positive because of the exchange rate and so many companies having international exposure in this day and age, global economy, if you will. Initially, it would probably be a good thing. But if we start to have the dollar move down here, um, that would be a whole different ball game, and that could create some fear in the markets. And maybe that occurs after the S&P tests those February highs and then if we get a corrective move, that could be exacerbated by this downward move in the dollar here, as maybe there's not as much confidence. We'll see if these trade deals get announced before July 9th. So keep an eye on that date because that's when the whole tariff thing comes back again. And we'll see how it plays out. The other negative is I've drawn these lines. I really like symmetry in the 5-wave Elliott wave patterns, just as I like symmetry in the 3-wave zigzag patterns. And this is very symmetrical. This is a well-formed 5-wave pattern to the downside on the dollar. So I still have in the back of my mind the possibility that we do break this 97.5 level and go down here. I would hate to see that for the markets, but you have to keep that in the back of your mind. You have to trade what the markets are telling you, not what you think is going to happen or what you hope is going to happen. One of the things we used to talk about back in the days when we did live educational events was hopium. People trade on hopium all the time, and that doesn't work. Just like drugs, it just doesn't work. And you have to trade based on what the markets give you. You have to take your emotions out. You have to take your preconceived notions out. And gosh, I experienced that in my own trading when I first started. When I first started trading, I didn't have a tremendous amount of knowledge, and I got really fortunate and made a lot of money in a short period of time. And then the more I learned, the more I thought I knew where the market should go. And I would trade on that. I would trade on based on the knowledge that I have now and the knowledge that I'm gaining, this is what the markets should do. Like the markets care what I think they should do. They don't. The markets are going to do what the markets are going to do. And if you trade based on where you think the market's going to go, you're not going to have success. And I didn't. And I gave back a lot of that initial money that I made when I first started trading when I didn't know anything. And so you go through this process of learning. And that's why we created ewotrader.com is to help people learn these things, getting trade ideas through alerts without having to go through the education that the market is very happy to give you, which is a very expensive one. You learn more from your losing trades than you do from your winning trades, and the market's happy to help you out on that. So prefer not to do that. Prefer to try to help people. That's why we do these events. It's why I do the U.S. market update for free. It's why we do TradeFinder for free. Is just to try to help people as much as possible so they don't make these same mistakes. You know, it's just like a parent, right? When you're a parent, you don't want your kids to repeat the same mistakes you made. They're going to make their own. Everybody makes mistakes. Kids make mistakes when they're growing up. But at least if they don't repeat the same ones you made, you feel like at least you've accomplished something in the world of parenting with your kids. And so that's what I view this. The ewotrader.com is my parenting model for people that want to become traders because so much of the market, and this is kind of a borderline conspiracy theory, but a lot of people believe that it's the big boys that control the markets and they take advantage of the average retail trader, and the average retail trader doesn't have a chance. And that's actually pretty true. The big boys do control it because they have the big volume and they can move markets on their volume where the average retail trader can't, regardless of all that meme stuff that came out of COVID and everything else. It was institutions, it was big boys behind watching those that set up the retail traders, encourage them to get them all in and then slam the door. And that occurs all the time. So anyway, get off that soapbox and move on to the rest of the markets. Let's go to the metals. And here's the move back down in gold. I had a commentary with someone that was talking about, isn't gold going to go to the upside? And we have this big triangle here. GLD loves to do this, consolidate, breakout, consolidate, breakout. We've had a heck of a run in gold, and specifically GLD. And my commentary was, yeah, we can come up with 100 reasons why GLD or gold should continue to move higher. But with this triangle, you have to respect the fact that it could break to the downside. So here we broke out. We came back and tested the point of the breakout. We held for a day or two, and then we get the drop today. So same scenario. Are we just testing the 50-day moving average in GLD? If we don't get follow through, maybe that's all it was. So we came past the point, and then we could turn and go back higher. So gold could still turn and go higher, but if we get follow through here and we break the 50-day moving average, then you have to look at this as a downward breakout, and this is a false breakout, a head fake, and gold could go lower. We don't have enough information yet. We have to wait another day or two and see what's going to happen there. Same thing with SLV, following suit here. We had all of this sideways consolidation following the gap up, consolidated 2 days, gapped up again, consolidated for 2 weeks, and we've given that up. We're below the 10-day moving average, but we did that again at the end of last week or at the very beginning of this week, and we had no follow through. We bounced up. Does that happen again tomorrow, or do we get follow through to the downside again? And maybe SLV has to at least come test its 50-day moving average, which coincides with where the support resistance line is, which takes you all the way back to the highs from the end of March. We need another day or so to understand where the metals may go. So we've talked about energy, we've talked about the metals, we've talked about the crypto space. Now let's go and take a look at the rest of the markets here in the US. And I like this move in the DIA. Once again, I wish it wasn't a gap up, but I've talked about this over the last few weeks. I'm not a big fan of trading the Dow or trading the DIA. I much prefer the S&P or the Qs, but this pattern is setting up really, really well. Where we had this little triangle, we broke out, we tested it, we held the point of the triangle, which coincided with the support level at 420, and we're getting a bounce back today above the 10-day moving average, and you see all this clean space here. So my point is that if you look at the chart of the DIA versus the chart of the SPY, see how close we are to those February highs here on the SPY? If you go back and look at the DIA, we're nowhere near the February highs. So there's more room to run in the DIA, I would submit, than in the SPY. And so perhaps we get a period of time where what was once Big Brother, we talk about gold and silver, with gold being Big Brother and silver being Little Brother in the markets. Historically, the Dow has been Big Brother, and then things have changed over time. It was the S&P, and then it was the Qs, and there still is a lot of movement in the Qs. So this looks pretty intriguing to me. And then we go to the Qs, and we are at a really interesting point in the Qs right now. Once again, a gap up, which, as you know, I hate. But look where we are. So I've been posing the question of what would you rather trade right now? We're testing those February highs on the Qs. We're not there yet on the S&P. We're not even close to it yet on the Dow, but we're there on the Qs. If we break above these February highs, there's clean space here in the Qs. There's nothing in the way. There's no resistance in the way. Racing in clean air, being the guy out front that has clean air coming into the engine, runs better, more performance. So what would you rather trade right now? You could make a strong argument that if we break above the February highs on the Qs, maybe that's the place to be rather than the Dow. But they're both quite interesting at this point in time. And then if we go look at the IWM, we still have the opportunity to go up to that 220 level, which is where I thought we talked about this in past trade finders, back to this 220 level. And that would break this wave 4. The 61.8% fib level did act as resistance, which it often does. The 61.8% fib level, in my opinion, is the strongest of all. And it did not surprise me to see that create a bit of a reversal. But look, we came down towards the 50-day moving average, the point of the triangle, and we're getting this bounce today. This is encouraging. So if you are bullish on the markets, I think the most encouraging thing, I know the Qs are testing their February highs and everything else, but the IWM, the small caps, are viewed as being more of a risk on, risk off indicator than any of the other markets. With the small caps, typically they don't do well unless you're in a risk on type environment. And if you're in a risk off, they greatly underperform the other major markets. So this move up on the IWM looks pretty good. Not quite as much of a gap, which I think is more constructive towards a continued move higher. But we got to break this wave 4 high first. So I think you just watch the IWM. You keep an eye on it, see where that may go. If it does violate this wave 4 and then disqualify this pattern, you can make an argument that the IWM may break that level at 220 and it go to the February highs at 230. So there's a potential there as well. Pardon me. So I know I'm talking like I have a stuffed nose because I do, because I've been sneezing my brains out all morning. So I apologize for that. I know it's annoying. I've listened to enough other podcasts and videos to know that it's annoying. So again, my apologies, but I've dealt with allergies my whole life. So it's just something that put up with. So we'll see if we test this level of the wave 4, then 220, and then the potential move to 230. So there's opportunities everywhere, I guess is what I'm trying to say, but we don't necessarily want to pull the trigger today, if that makes sense. So we'll continue to keep an eye on that and see where things go from here. With that, I'll take a look quickly at the VIX, and then Zach will open it up for Q&A. Been talking a lot, and I do want to leave time for questions. The VIX did go up. Look at that yesterday and touched the 22.5 level. Couldn't break it. We've got this range between 17.5 and 22.5. We briefly broke below it. Looked like we're going down to 15. I have that middle line drawn there because 15 was support for the first few months of the year. And maybe we're going back down there. This wave 5 pattern's disqualified. So that you don't pay any attention to that. You just look at these trend channel lines here on where we could go. And there is a bit of support here between 12.5 and 15. So what does that mean? At least for now, we're going to keep a slightly heightened level of volatility. It's not extreme by any way, shape, or form, but there is a little more than average volatility in the markets. And until we break down towards 15, and I would argue break below 15 and head back down to that lower line at 12.5, which acted as support numerous times. And you can see last year during the summertime, we hung around 12.5 almost every day. Typically, when we move into the summer months, we do have less volatility. That's just historical norms. But we got a long way to go down on the VIX if we're going to get down towards that 12.5 this summer. We're getting here towards the end of June now, and perhaps that's fuel for all of those markets to move higher. The Qs, the S&P, and the Dow, and the IWM as well. But we got to get down towards 15 and threaten to break below that before we feel comfortable there. So now we are constructively bullish, especially based on those macro charts. Again, I invite you to go look at the U.S. market update and see them. You can use the chapters feature on the recording, go directly to them. You don't have to watch the whole recording if you don't want to. You can just look at the segment on those charts. But they are supportive of all the things that I've been talking about today. So, Zach, let's go ahead and open for questions. And then at the end of the session, you'll move and show our case study consideration for this week's TradeFinder. I will update you on the one from last week, which was AR. That was an AI trade as well. You can see the AI situation here. It's a little below what we like. The 75% or higher score is what we prefer. And we got a little bit of separation here from the 10-day moving average. And this is the point where we need to hold. We tested the 10-day moving average and bounced. And then we have a ton of support right here through this level, exactly where the 10-day moving average is, because those were the highs in January, in February, in March, in May. We broke above it here in this month in June. We're testing that level now. Very normal, common things that occur. You break a long-term resistance level and you usually come back and test it. What was resistance? Is that now support? That's what we're doing now in AR. So that's the update from last week's case study. And then we'll have a new one today. But for now, Zach, I'll open it up and take a few questions before we get to that part of the webinar.
Sounds great. Let's get right into it. Let's check out hymns for Lisa.
HIMS is actually on our AI list. So let me show you that. And I find that quite interesting. I don't know if you are a subscriber to the AI signals, but there you go. It's in the sideways after drop. And this is very likely going to be the top shot alert this week. It's not going to be our TradeFinder alert, but it might go into top shot because look at this big boundary here. We got a lot of room to stay within. Ideal setup for a calendar spread, something along those lines. And it's a 73% score. This little second half of it looks like a pill here shape is gray because, again, the score is below 75. I like anything above 70. The AI scientists tell us to look for scores of 75 or above. And if it is, that'll be green, green for go. The gray area here is like, it's still pretty good. It's not quite green, but this has shown in the past that it can go through periods of sideways movement. We had this breakout at the beginning of the year when everything moved up. We came back and went sideways, broke up, kind of went sideways, looked like we were going to break higher, and then the big drop. And I feel like perhaps we go through an extended consolidation here. So that's what I think is going to occur in HIMS, is that we go through a bit of consolidation through this period. So interesting that you ask about that, Lisa.
Agreed. And next up, let's head over to QBTS for Skyper.
And yep, this is what everybody's looking at, right? Yeah, AI almost seems to be old news now. Everything's quantum. And the CEO of NVIDIA, Broadcom, et cetera, they're all talking about, yes, quantum is coming. We might be a little bit early, but it's coming. And maybe we had to come down and fill some of this gap here on QBTS. We are holding, at least for now, the 50-day moving average. But I think if you're going to go long, you want to wait till we're back above the 10-day moving average. If you're already long, I don't see any reason to get out, not unless we break this 50-day moving average, because we could still come a little lower, test the 50-day moving average, completely close this gap, and then maybe we bounce off that. So for now, it looks like we're in a corrective wave 4. It's green, so it's still active. It's qualified, but not confirmed. And so maybe we come back down a little bit more, but I would keep a close eye on this. So again, if you're long, I wouldn't exit unless we broke the 50-day moving average. But if you're looking for an entry, I think you wait until we show that we can get back above that 10-day moving average, and then maybe that is it for the wave 4. But that 50-day and the bottom of this gap is too close right now, I think, to be really strongly long at this point in time.
A couple of questions from JJ. First one is, could you explain why war times are good for the markets?
Well, there was a view in the past that because of all of the munitions that are used, and things are different now, right? I mean, the U.S., you got to say, whether or not you're in favor of war or bombings or anything, they were pretty clever. They sent B-2 bombers to where they thought they might be able to be detected in a completely opposite direction of where the bombers were that dropped those buster bombs on those three facilities in Iran that have shown to be facilities where they're enriching uranium, which they said they weren't doing. That's what started all this. They lied. Iran lied, no doubt about that. They said they weren't doing it, but they were. And so the determination was to protect our friends in Israel. We need to at least slow that down dramatically. There's nothing to stop Iran from starting over again, but it certainly postponed things since Iran has come out and said they want to wipe Israel off the map. And Israel's our friends. So that's what was occurring there. But going back to answer the question, using all the munitions, it would create manufacturing, right? When we were in a manufacturing economy, you had to produce. It was good for steel. It was good for all the components that go into munitions and bombs and airplanes and boats and all the equipment that our soldiers need and everything else. So it would be a boom for manufacturing during wartime because all these things needed to be made and replaced, et cetera. And so it would put a boost under manufacturing. We don't manufacture as much anymore in the U.S. We farmed a lot of that out. That's what President Trump's trying to do, and is bring manufacturing and production back to the U.S. and trying to do it in a means that is cost effective. And that's a big battle. And whether he wins that or not, who knows? That was kind of a pun with the battle. I didn't mean to do that, but historically, that's why wartime has been good for markets because it gives a boost to a number of different manufacturing areas. So it helps the U.S. economy through manufacturing. Would it as much now? I don't know, but you have these historical norms and people rely on those. And that's why there's been commentary, if you've been listening to the financial network, saying the same thing that I am, that historically it almost seems counterintuitive, sad in a way, but that wartime has been good for the economy. And that's why. Again, you could make an argument that, well, if we don't manufacture as much stuff in the U.S. anymore, is it really as much of a boom as it has been in the past? But it's all perception, right? And we still are in that perception. I think it'll take years, if not decades, if manufacturing continues to be overseas before that thought process goes away. It's still in the back of people's minds. And you go back and look at the world wars, et cetera, in the past, and you look at conflicts that we've had. And yes, the markets get very volatile with headlines, just like what occurred Monday when we were doing the EWO Trader Live when Iran fired those missiles back. The market immediately dropped down. And then when it showed right as we ended the session, that basically almost all of them, if not all of them, were intercepted, the market turned and ran back up. So you do get those short-term volatility things with war headlines, but over the longer term, it tends to level itself out, and then we move higher, which does go along the lines of what we've been talking about with the S&P and this potential to move back up towards those February highs. Good question, though.
Good question and a good answer. Well said there. We'll follow it up with AMD.
I figured that. I was really surprised this didn't come up last week, Zach, because we talked about this and AMD was coming up, and I made the comment. I do like to pat myself on the back when I'm right, and you have to admit when you're wrong as well, because no one's right all the time. I'm not for sure, but when we were down here and AMD just seemed to be lagging, I made the comment, not because of AMD specifically, but when you're looking in a particular sector that's doing well, what money tends to rotate to is where are the stocks that are underperforming in a sector that is performing, because that tends to be where you can get a better bang for your buck, if you will. And that's exactly what's happened with AMD. It was greatly lagging. It wasn't participating with, and Microsoft, the exact same thing. You can look at the chart of Microsoft. It's just like this, where it was greatly underperforming Meta, Nvidia, Broadcom, all the other ones that that were doing well. And now there's a renewed bid in AMD. I would argue now that we're at a point where we might need to be a little cautious here because now we're at this area that consolidated at the end of last year, right here around, what is this, about 145. I'll give you the exact price level here. Yeah, right around the 143 to 145 area. Could be some resistance. Plus, in today's move, we're a little bit overbought, but there's the catch-up move. What we talked about with silver, it did it. AMD's doing it, and I'll go ahead and bring up the chart of Microsoft. So to answer the question, I think you have to be cautious right now on AMD until we break above 145. Then you go long again. Again, if you're already long, stay there, but tighten up your mental stops and be ready to take your gains and move on if we turn back from that 143 area as the catch-up move has already occurred. But if it can break that, then I think you have a new long. Here's the same thing. Look, the chart very similar of Microsoft, the exact same thing. Big move down here, and then we turned and went back up. And we had big surprise earnings report here, caught the market by surprise. So you had a lot of short covering on this gap up, and we haven't even really thought about coming back to fill that gap. Now with Microsoft, I just don't see how we don't hit 500. We're only 10 points away, and that's one of those big round numbers, the tractor beam effect that I talk about. Then we'll have to see what happens with Microsoft when we hit 500. But I really think 500 is in the cards for Microsoft. And anyway, same story there with AMD.
All right, we've got a question on, do you think this entire move up since April is a wave B of the higher time frame?
Well, let's take a look. Always, there is an old expression from Ralph Nelson Elliott. Always look at the higher time frame, and so that's what we'll do. Here's the weekly chart of the SPY. I assume that's what you're talking about, or maybe you were talking about AMD. But there's those zigzags that are in the daily chart and coming towards those February highs here. Once again, no Elliott Wave pattern labeling on the S&P, even on the weekly chart, which I find really, really interesting. Let's see if we can bring in more data here and get an Elliott Wave pattern. You can see the data points down here. I have it set at 377. And if we go back far enough, then we actually can get an Elliott Wave pattern on. And this is showing a perfect, I call it perfect, 50% corrective move on the weekly chart. So is it a B wave? You could make an argument that your zigzag started back here at the beginning of the move, and then we ran up, and then that wave 4 was the B wave of a zigzag, because if you see, it's going to overlay here, but we're right at that 61.8% level, and that would send us up to those February highs as well, if not potentially higher, up to we could go as high as this level here, which is 675. That could be a ways off. That moves us more towards 2026, so kind of the end of the year, maybe. I still feel like we'll find out when we hit those February highs. We have to respect there's a chance that we get another corrective move and we could add another zigzag in here if we get turned back at least a little bit from the February highs before resumption of the move higher. But longer term, it does look like we're going to go higher. So good catch there. Yes, it could be a B wave on the longer time frame. So respect the higher degree is what Elliott called it. And that's what the weekly chart is. Man, that's why I love doing these. I love it every week. I like doing TradeFinder. We have such a great base. I hope that you all will go out and encourage other people. It's free to sign up because you guys are a fantastic community and you ask such amazing questions, and these sessions are always really, really good.
No doubt about that. And I see we have a couple minutes till time, so perhaps I'll pass through one more symbol to you, and then I'll give you time to show everyone the case study consideration for this week.
Yep, sounds good. We're going to go out on a limb this week, so it's going to be a post, not an idea. So just let you know that. But go ahead, one more question, and then we'll do that.
No worries. Yeah, that works out as well. You can spend a bit more time on your analysis there, and everyone can just look for the post after the session. So symbol will be TAN.
Again, coming up with stuff. Now, solar has been not had a good time here of late, as you can see, and it's a very volatile sector. But we are back above. You got to love that symbol, right? For solar, tan. But we came down to the 50-day moving average. We had broken nicely here. Just a good example of pretty much every rule that we talk about. Let me spend a minute here, Zach. Sorry, we'll be a little bit late on getting to the post, but this is important, I think, educational at least. There was an ascending triangle right there. And what I hope, my main hope of doing all this is that, and I hope it doesn't sound egotistical, I don't mean it to, but just for people to start looking at charts the way I do, where you don't just see a bunch of lines or candles, depending on what your favorite method of showing the data on a chart is, but you start looking at these patterns that show up week in and week out, day in and day out. So we had an ascending triangle, we broke out of it, and we did one of the three ways. We broke vertically. But you know what happens when you go vertically up? What happens, Zach? You go vertically up, you likely come
Vertically back down.
and that's exactly what happened. That's why I keep saying these same rules over and over and over again. You got vertically up. We got too far from the 10-day moving average. We came back down and satisfied that part. But then we also continued down vertically, got almost exactly to the point of the triangle. And then we took off again, a little too vertical. And for me, if you're moving past 45 degrees, which would be somewhere about here. I don't have a protractor on my screen, but it's somewhere around there. If you get more vertical than that, you're going too vertical. And the reason that I like 45-degree angle moves is because they tend to have less severe, less volatile corrective moves. So when you start to go more vertical, then you have to be aware, gosh, we could get a bit more of a volatile corrective move. That's what happened there in solar, and that's what's going on in solar land. It's had a rough time. But we're trying hard to hold the 50-day moving average. So we got vertically up, came vertically back down. We've held the 50-day moving average. Right now, we're at that 10-day moving average. So if we can get back above that, and then I would argue calm down a bit and go more on a bit of a 45-degree angle move instead of these vertical moves that it's doing, maybe we can have some sustained move in the solar space. I don't think solar energy is going to go away, but man, is it a volatile sector. So you've got to have an iron stomach trading in here, but that's what I see on TAN right now. All right, Zach, so past time, let's go ahead and go. This is just simply going to be a post. And you can explain what that means to the folks, but it is going to be on UNG. So you go ahead and get started, and then I'll give you the particulars.
Okay, very well. So I'll go ahead and take the screen over here. All right, and we should be good now. So as we'll see, we're at a menu view, a jumping off point of this ever-growing platform. As Rob mentioned, this is just going to be a post, but to get to the post, we are going to go to this light bulb for ideas, come over to this left-hand toolbar for a new idea, and instead of creating an official idea, which could be equated to paper trading for whichever brokerage you may use, we're going to do a post, which is more of a discussion board in this forum. So this is going to be on UNG, and we will come back and make this a lot prettier right after this session wraps up. And as I always say, we welcome your opinion, whether you agree or disagree on an official idea. You have the opportunity to actually hit the agree or disagree button and then, add your comments on supporting evidence there. You can still just add your comments on a post as well. And again, whether you agree or disagree, we welcome you to share your feedback. Just be considerate of the community and have your points validated with your thoughts there. But if everyone agreed, there'd be no transactions, there'd be no open interest, there'd be no trades to take advantage of. So again, either way, we look forward to hearing your feedback. And Rob, I'll pass back over to you to provide your quick analysis and closing thoughts.
Sounds good. Good job. Good explanation, Zach. And basically what we're going to do here, and the reason this is just a post, is because it's a thought. I'm going to look at this as, and taking into account the fact that I do think these data centers moving towards natural gas, et cetera, is going to keep some sort of a bid under natural gas. And we still have this potential of a wave 5 move down. We have not violated the previous 4, so we aren't following the rules. That's why it's a post, not an idea. As Zach mentioned on ideas, those are something that, yeah, you would paper trade those, put those in your account. But as a post, it's just a thought, a consideration, and not necessarily something that you would act on, whether you're doing it in your own account or just watching along. So we got the screen back, and basically what we're looking at here on UNG is that I'm going to put out the opinion that we hold this point, that we are testing the point of this triangle, and that natural gas moves back up. So you can see why it couldn't be an idea, because the wave 5 is still in play. We could still go down here. So we're not following the Elliott Wave rules. One could certainly make an argument that look at this trend line here of lower highs, and maybe we do go down to this wave 5. And that is a distinct possibility. So going on the fact that I think there is going to be heightened demand moving forward as we get past this tariff stuff and the war considerations, et cetera, that a little bit of a bid comes back into natural gas. And so I'm just going to throw a flyer that we hold the point of the triangle and we move back. We may not. So this is just something to keep an eye on, not something you would want to act on, as I said, because it doesn't follow the rules that we put out for any of our portfolios at Evo Trader. So we'll see how it plays out. We'll take a look next week and see. I could very well be wrong. But we'll find out and we'll see how that goes. So thanks as always for your attention, spending some of your trading day with us. And, headlines ever changing and volatility here to stay. We'll see what happens with that gap up today. We'll be able to update that for those of you that are alert subscribers on Thursday night's insiders meeting. And then next week during TradeFinder, we'll see what's going on there. So have a great rest of your afternoon. Look forward to talking again